Welcome viewers to part one of our screencast on how the Tax Cut and Jobs Act will affect all of us, or where estate planning and business planning intersects and overlaps. My name is Richard Land. I'm an attorney and a member of the Danbury, Connecticut law firm known as Chipman Mizuko. My goal in this screencast is to introduce you to the aspects of the new tax law known as the Tax Cuts and Jobs Act, which are likely to affect most people. I'll be doing that with a case study which will show you how the new tax law will affect our fictional client, who we will call Joe the accountant. I'll be referring to the law as the new tax law. Keep in mind that the new tax law was effective January 1, 2018. The provisions I'll be discussing are expected to expire after 2025. So here we go. I believe the Tax Cuts and Jobs Act is revolutionary and will change the way we all think about how we structure our business activities, how we get paid, and how we pay others. I'm going to show you why I think that by showing you how the new tax law affects Joe the accountant, who is a Connecticut accountant who practices by himself as a solo practitioner. I don't want to get lost in the weeds, so I'm going to focus on just a few provisions of the new tax law which could affect a lot of people. Here they are. I'll be covering limitations on the use of state and local income taxes as deductions on your 2018 personal income tax return, the loss of the personal exemptions that you've been entitled to use as deductions, limitations on the deduction for interest payments on mortgages that you may have been using as deductions, an increase in the standard deductions that you would use if you did not itemize deductions, a reduction in tax rates that apply when determining your income tax, and the new, what I consider revolutionary, 20% deduction for income from certain trades or businesses. This income is being referred to as pass-through income. I believe this 20% deduction for pass-through income will impact many more people than expected. As we examine these provisions, I'll be keeping in mind that the new tax law was sold to us taxpayers as tax reduction legislation. Will it deliver on that promise? Let's look at an example. Here's some information about Joe the accountant. Joe the accountant is married and files a joint income tax return with his wife. All his children are adults, out of the house, and self-sufficient. He lives in Connecticut. His income tax bill to the state of Connecticut is $15,000. He pays $10,000 in real property taxes, and he pays mortgage interest in the amount of $13,000. His only source of income is what he makes as an accountant, which is $275,000. Let's compare what his income tax situation would be under 2017 rules with his income tax situation in 2018 under the new tax law. First, let's look at what the new tax law has done to Joe's itemized deductions. Here are the itemized deductions, a total of $38,000 consisting of real estate taxes, Connecticut income taxes, and mortgage interest. In 2017, subject to some phase-out provisions which do not apply to Joe, Joe could take all of these as deductions when computing taxable income. But in 2018, look what happens. These deductions have been reduced. In 2017, Joe could deduct all his state and local income taxes, a total of $25,000. Under the new tax law, he loses $15,000 of the deduction because, starting in 2018, the deduction for state and local income taxes has been reduced to $10,000. So Joe loses $15,000 of his $25,000 in itemized deductions for state and local income taxes. He's thinking that, at his tax bracket, this loss of deductions could increase his taxes by around $4,000. He's getting a little nervous about that, but he knows there's a lot more in this analysis, so he's not too worried yet. He also knows that the new tax law limits the deduction for mortgage interest. The first change is that in 2018, the mortgage interest deduction can only be taken for acquisition indebtedness. Second, it's limited to interest paid on no more than $750,000 of indebtedness. Joe's mortgage is much lower than $750,000, so he's relieved to know that he does not lose any of that deduction. Nevertheless, he sees that when he compares his 2017 itemized deductions with his 2018 itemized deductions, he's lost $15,000 worth of deductions, and he's not pleased. What was a $38,000 deduction for itemized deductions has become a $23,000 itemized deduction in 2018, a decrease of $15,000, and he thinks that can't be good. Then he takes a look at his personal exemptions. Before the new tax law, to arrive at taxable income, each taxpayer was able to reduce income by personal exemption. In 2017, the personal exemption was $4,050. So in 2017, Joe the accountant could take one exemption for himself and one for his wife for a total of 2 exemptions, resulting in a total deduction for exemptions equal to $8,100. If Joe had dependent children, he could also take a personal exemption for each dependent child. For example, if you have 3 young children, you would get 3 additional exemptions, or $4,050 each. That would be additional exemptions of $12,150. So a family of 5 could have 5 exemptions equal to a total of $20,200. That's a pretty nice deduction that could reduce tax by approximately $5,000, depending on the tax bracket of the taxpayer. The new tax law eliminates all such exemptions. The impact is not quite so large for Joe because he has no dependent children. When Joe loses the exemption in 2018, he only loses 2 exemptions. That's an additional loss of deductions in the form of exemptions equal to $8,100. To recap, Joe has not only lost itemized deductions equal to $15,000, he has also lost exemptions equal to $8,100. That's a total of $23,100 in lost deductions. Joe's thinking that, as a result, in 2018, his taxable income will be increased by $23,100, and his taxes will be increased by about $6,000. Joe knows that there's more pencil pushing to do, but he's worried that maybe the new tax law that was supposed to reduce his taxes has somehow done the opposite. Joe presses on, looking for the silver lining in this dark cloud. Now we will look at some of the new tax law provisions that were effective on January 1, 2018 that will help taxpayers. Let's look at the standard deduction first by comparing itemized deductions with the standard deduction. A little earlier, we were talking about some of the most common itemized deductions. Let's review what we mean by itemized deductions. The tax law in 2017 provided that certain itemized expenses could be used as deductions when computing the income that will be taxed. A big part of that were deductions related to home ownership, such as real estate taxes and mortgage interest payments. As the taxpayer, you got to add all those items up and then subtract the total from gross income to arrive at taxable income, and then you would compute your income tax on that reduced income amount, which would be your taxable income. That's what we mean by itemized deductions. As an alternative, to help taxpayers who do not have some of those favored expenses, the tax law allowed everyone to take a standard deduction instead of itemizing the deductions. In 2017, the standard deduction was $12,700 for a married couple and $6,350 for a single person. Under the new tax law, effective January 1, 2018, Joe's standard deduction, the one that applies to married taxpayers who file joint returns, is increased to $24,000. Let's see how that works out for Joe. Joe looks at his itemized deductions, and he sees that now, because his itemized deductions for state and local taxes have been capped at $10,000, his itemized deductions in 2018 will be $23,000 instead of the $38,000 that it would have been in 2017. He then compares his itemized deductions, that's the $23,000 amount, with his standard deduction of $24,000, and he sees that he can take the larger $24,000 standard deduction instead of the smaller $23,000 itemized deduction. It's only a $1,000 difference, and it won't save much tax, but it will simplify his tax return, and, at least as far as Joe's concerned, it's going in the right direction. I believe this will be something many more taxpayers will decide to do. Even homeowners will opt to use the standard deduction instead of itemizing deductions, and the larger standard deduction will be very important to taxpayers such as renters who do not have home ownership expenses such as real estate taxes and mortgage interest to pay. Let's get back to Joe's situation. In 2018, now that Joe sees that the new standard deduction will provide a larger deduction than the itemized deduction, and after taking into account that he will get no deduction for personal exemptions in 2018, his taxable income in 2018 is still $22,100 more than it would be in 2017. In 2017, his taxable income was $228,900. In 2018, his taxable income will be quite a bit more at $251,000. He's still thinking that, based on his reduced deductions and his resulting larger taxable income, his tax will be close to $6,000 more. His next step is to actually compute the tax on his taxable income based on the new tax tables. So, Joe the accountant then does what accountants do. He goes to the tax tables, and this is what he finds. All up and down the table, he sees that the tax rates have been reduced. Remember how the loss of deductions increased his taxable income from $228,900 to $251,000, an increase of $22,100. Now he checks the tax table to see where he fits in as a married taxpayer filing jointly, and he sees that at that level his maximum rate is now 24% when it used to be 28%. And the income tax rates in the brackets below his highest bracket have also been reduced. Joe the accountant is surprised to see that even though the new tax law increases his taxable income by $22,100, Joe's final income tax obligation in 2018 will be $2,200 less than it would have been under 2017 rules. Working on Joe's income tax return for 2018 has been kind of a roller coaster ride. Joe was quite glum as he contemplated the possible result of losing $15,000 worth of deductions when the deduction for state and local taxes was capped at $10,000, and when he realized that he would lose exemptions equal to a total of $8,100, a grand total for lost deductions equal to $23,100. Joe really did not expect other provisions of the new tax law to make up for that. Although he was thankful that the cap on the mortgage interest deduction did not affect him, he held out little hope that the increased standard deduction or the lower tax rates would salvage the situation for him. But they did. After all was said and done, he was relieved to see that his tax bill would be reduced by $2,200. In the grand scheme of things, maybe $2,200 is not a huge sum, but it is something. And although he was not giddy with excitement, he was quite pleased. His good feelings were tempered, however, when he was thinking about how all this would affect his clients. Their situations were quite different from his. For example, his clients who had a lot of exemptions because they had large families would be severely affected by the loss of exemptions. He also noticed that in one of the brackets, the tax rate actually increased from 33% to 35%, and he thought about all his clients in that bracket and how it might affect them. And the limit on the deduction for state and local taxes was bound to hit his Connecticut and New York clients very hard, and he worried about how that would be just one more reason loaded on top of so many other reasons for his clients to contemplate moving to other lower tax states. He knew that his clients would be calling him and asking him for his view about how the new tax law would affect them, and he decided that about all he could say for now is that the new tax law is likely to affect everyone a bit differently, and he wouldn't be able to answer the question until he got into the details of each taxpayer's situation. Having contemplated all these things, he did realize that he had not yet delved into the mysteries of the revolutionary 20% deduction for pass-through income. That will be the next topic for discussion in part 2 of this video series on the new tax law. We will cover what pass-through income is, what a pass-through entity is, which will include sole proprietorships and independent contractors, a much broader array of taxpayers than most people think, how the deduction is calculated, how service businesses are treated very differently from non-service businesses, and how to plan to make certain that you don't lose the opportunity to take full advantage of this very important tax deduction. It has the potential to help so many more people than you think. We look forward to talking to you in part 2.